What is the white coat investor philosophy? We talk about all kinds of stuff on the podcast. We talk about all kinds of stuff on the blog and in the newsletters, on the forums and the subreddit and the Facebook group. People ask my opinion about stuff all the time, and I readily give it on everything from cryptocurrency to market timing to selling options, whatever. And that causes a lot of people to miss the forest for the trees. Okay, so today I want to talk about the forest, the important things, these timeless financial principles that are important. These are the hills I'm willing to die on when it comes to personal finance and investing. I don't really care so much to talk about some obscure crypto asset, but these are things that really matter and that I think white coat investors really ought to agree on. I mean, you can argue against any one of these points if you want, but I'm going to vehemently disagree with you, and I'm probably going to win the argument. So let's go through the 12 points of the white coat investor philosophy. Here's the first one. Financial planning makes you happier. I am 100% convinced that financially secure doctors are better partners, parents, and practitioners. By doing real financial planning, you're going to have less stress, less burnout, less divorce, less suicide. You're going to be happier. You're going to provide better patient care. You should just do it. Okay. Financial planning. It matters. It affects your life. Okay. It's not onerous like budgeting or something. It's something that's going to make your life better. Okay. Point number 2, real wealth comes from making a lot of money and saving a lot of money, not from some obscure investment strategy. Okay. When I first started the White Coat Investor, I thought I'd be writing about investing and estate planning and asset protection. But the truth is, what really matters is maximizing your income, maximizing your savings rate, carving a big chunk of that high income you got out and using it to build wealth. It doesn't matter if it goes toward paying down debt. It doesn't matter if it's going toward investing. It doesn't matter if it's going toward a down payment or an emergency fund. All of it builds your net worth. Focus on the stuff that really matters. You'll become wealthy. Okay, point number 3. And I can't emphasize this enough. And I'm disappointed actually when we do surveys of white coat investors and I find out that 50% of them still don't have a written investing plan. You need to have a plan and you should write it down. 2 benefits of writing it down. 1, you can go back and see what your plan is and why you put that plan in place. So that's number 1. It exists better when you write it down. 2, as you write it down, the act of writing it down shows to you where the gaps in your knowledge are. And it shows you where you need some more work, where you need some more learning, more education. Okay? Get a plan. There's 3 ways to do it. If you've read enough books, spent enough time on forums and blogs, you can just write the stupid thing yourself. It's not that hard to do. That's how I did it. If you need a little bit of help, look at our Fire Your Financial Advisor online course. It's designed to take you from zero to hero to help you write your own written financial plan. That costs you a few $100s. If you still need more help, for a few $1,000s, you can hire a financial advisor to help you draft up a written investing and financial plan. And you can just implement it and follow it or hire assistants to help you implement and follow it. But the truth is, you need a reasonable plan. There's lots of reasonable investing plans, and you need to adequately fund it, and you'll get to your investing goals. Point number 4, index funds are the best foundation for a portfolio. Now, there's 100 things you can invest in, whether it's cryptocurrency, whether it's commodities, whether it's options, whether it's real estate, whatever. Okay. And it's okay to have a unique portfolio that reflects your interests. But the foundation of your portfolio should be index funds, low cost, broadly diversified, static asset allocation of index mutual funds. This method of investing is basically free. There's hardly any monetary cost, time, or effort required to manage a portfolio of index funds. Expense ratios are under 10 basis points a year. That's pretty much free. It takes very little time and effort to monitor the portfolio, to maintain the portfolio, to rebalance the portfolio. Yeah, you got to put your contributions in each month. That's probably what takes me the most time every year, is just putting my money into the plan. Maybe you rebalance once a year. If you're over 72, you got to take a required minimum distribution out. But literally, this sort of portfolio can be managed in an hour a year. It doesn't take that much time. So it's a great foundation for an investing plan. Now, you want to get a little fancy here and there, that's fine. You want to do a little bit of market timing or a little bit of stock picking, fine. You know, you want to have, some speculative assets, some precious metals or crypto assets or beanie babies or commodities or some empty land, whatever. Limit that to a single digit percentage of your portfolio. If you want to build a real estate empire on the side or put some of your money into a small business that you have significant control of, those might be some of your best investments, and that's okay. But recognize there's going to be some more work there, and you've really got to get into the details of it to do it right. But still, add it onto a foundation of index funds. All right, point number 5, insure well, but only insure against financial catastrophes. You do not need to insure your iPhone. You do not need to insure your snowblower. Okay, you're a doctor. You make $10,000, $20,000, $50,000 a month. You can buy a new snowblower if it goes out. You can buy a new iPhone if it goes out. You need to insure against financial catastrophes. That's disability, death, health, liability, loss of expensive property like your house burning to the ground. Those are the types of insurance you should buy, and you should insure well against them. Okay? But if it's not a financial catastrophe, you don't need to insure against it. There's a cost to insurance. On average, insurance is a losing proposition. It has to be. Doesn't mean you shouldn't buy it, but you shouldn't buy more than you need. The classic example, of course, is whole life insurance, where you're insured for your whole life. Well, if you're insured for your whole life, it's going to have to pay out because you're going to die eventually. Thus, it has to cost a lot more than insurance that just covers you while you actually have a need for life insurance. It's not unusual at all to pay 10 times as much for whole life insurance as for term life insurance. Point number 6, live like a resident for 2 to 5 years out of residency. Consistently, if you listen to our Milestones to Millionaire podcast, you will hear people who do this and become financially successful. It works very, very well. The math is undeniable. If you will earn like an attending, spend like a resident, you can use the difference between those figures to do all kinds of awesome financial stuff, like pay off your student loans very quickly, max out your retirement accounts, become a millionaire, save up a down payment, get an emergency fund in place, all these great things you can do with your money. Don't do it forever. It's okay to grow into most of your income eventually. But for a period of 2 to 5 years out of your training, I recommend you try to live somewhat similar to how you lived in training. And you will find that it is the secret to becoming wealthy as a physician. All right, number 7 is to spend intentionally. And I don't care what you spend on. Maybe it's a Michelin 3-star restaurant. Maybe it's a private school for your kids. Maybe it's the fanciest daycare ever. Maybe it's fancy vacations to Bali. I don't know what you care about. What I'm telling you is be generally frugal and selectively extravagant. If $10,000 handbags are your thing, well, you're going to have to be cheap everywhere else and buy those $10,000 handbags or mountain bikes or whatever it might be. But that should be your goal, is to spend intentionally. Number 8, get good advice at a fair price. Okay, you either need to learn how to be your own financial planner and investment manager, or you need to find somebody who does it well for a fair price. Fair price generally means a 4-figure amount. You want to spend a little bit more than that, that might still be okay. But if you're paying $50,000 a year to your financial advisor, you're getting ripped off. If you're not sure how much you're paying, you're probably either paying in commissions, which is a really bad idea, or you're paying an AUM fee and not actually doing the math. If you have an AUM fee of 1% a year and you have $300,000, that's $3,000 a year. That's probably a good deal. If you have $5 million, you're paying $50,000 a year. That's not a good deal. Good financial advice and service is expensive, but it's not that expensive. Okay, point number 9. Understand and use your tax-advantaged accounts. There are special accounts out there that provide easier estate planning, that provide asset protection, and most importantly, they give you higher returns because they protect your growth from taxes. And you should use these. You should max them out when you can. We're talking about 401ks, 403bs, 457bs, 401as, HSAs, 529s, individual 401ks, cash balance plans. There's all kinds of these accounts out there. You ought to understand them, how they work, and use them. Get the plan documents, read them. Remember, your second job is to be a pension fund manager. Learn the contribution limits and try to max them out. You need to understand how these accounts work. They're the single greatest tax break available to most practicing physicians. Number 10, pay cash and avoid debt. We all become numb to debt in medical and dental school, we just get used to living on borrowed money. And then we come out, we owe $500,000 in student loans, and we get a $500,000 mortgage, and we get a $500,000 practice loan. Before you know it, you owe $1.5 million and you're making $150,000 a year. That is not a good deal. Okay, here's the truth of the matter about life and finance. Ask yourself, do you want to earn interest or do you want to pay interest? And the truth is, you can ask any 6-year-old and they'll get the answer right. They want to earn interest. If you would rather earn interest than pay interest, get in the habit of not buying stuff that you can't afford. Okay, if you've seen the Saturday Night Live skit with Steve Martin, you know what I'm talking about. If you've never seen this skit, you should definitely go watch it. Just Google, don't buy stuff you cannot afford. Bottom line, if you can pay cash for it, you can afford it. Yes, I know there's a few things in life you're probably going to have to borrow for, like a medical or dental school education, buying a house, maybe a first car, an expensive used car. After that, stop borrowing money. Don't borrow money to buy a snowblower. Don't borrow money for your vacation. Don't borrow money to buy your cars. You're a doctor. Make $20, $30, $40, $50,000 a month. How long does it take to save up for a car? Not that long. Okay? Buy stuff with cash. Get into the habit of buying stuff that you have saved up for, and all of a sudden you'll find that you're a wealthy person. Wealthy people not only invest money, they also pay off debt. Okay? If you make enough and save enough, you can do both and still live a life where you don't feel deprived. All right, number 11. Taxes, taxes, taxes. Minimize your taxes and know the tax code. The tax code, it's very, very thick, right? If you look at every page of it. But the basics aren't that hard to understand. You need to know the difference between a deduction and a credit, and an above-the-line deduction versus a below-the-line deduction. Know where the various schedules and forms feed into the 1040. Know the difference between how qualified dividends and long-term capital gains are taxed. There are small or sometimes large changes to the tax code every year. But if you learn the basics, it's going to be mostly the same system every year of your life. If you understand how it works today, then you'll find it easier to understand the changes as they go. There are so many people out there that do not understand how taxes work. It's amazing. Everything from the tax brackets to how deductions work, write-offs. You've heard people talk about how awesome something is, that it's a write-off. Well, it's not as awesome as they think half the time. But you can't win this game without knowing the rules. So learn the rules, learn the tax code. The final point is about asset protection. And the truth is that asset protection is actually pretty easy, but it matters a lot less than you think. Too many of us doctors are so afraid of losing everything to a malpractice lawsuit. It is actually incredibly rare for a doctor to lose personal money in a lawsuit. To actually have an above policy limits judgment that is not reduced to policy limits on appeal. We're talking less than 0.1% of the years in which you practice. Probably 0.01% of the years in which you practice are you likely to have that sort of a lawsuit. So for the most part, we're playing with the insurance company money. You're kind of like the defense witness for the insurance company when you're in a malpractice lawsuit. That doesn't mean you shouldn't still do the easy, simple, effective, cheap asset protection stuff. Okay? Buy professional and personal liability insurance. Title your property properly, usually tenants by the entirety. Max out your retirement accounts. Understand your state asset protection laws. My state protects a year of food storage, for instance. It's the only state in the country that does that. See my book on White Coat Investor's Guide to Asset Protection for details about your state's asset protection laws. Put your rental properties into LLCs. When it makes sense, form LLCs and corporations for your businesses. Once you're wealthy, use sensible, irrevocable trusts for estate planning purposes and reap the asset protection benefits too. Most importantly, remember that the big risk is not your patient. The big risk is your spouse. Divorce rates range from 10% to 50%. So date night is always going to be your best asset protection technique. As I mentioned earlier, if you want my opinion on a niche personal finance or investing topic, I'll gladly give it to you. But these 12 timeless principles are the hills that I'm willing to die on, and the ones that the White Coat Investor is going to continue to promote over the years.
The hosts of the White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.